Good evening, everyone. Welcome to this webinar where we will share about investing in Singapore for the road ahead. So joining us today is Colin Low, Yo Hui as well as Chloe Helen from our research team, and Darren Liu from our investment advisory team. I'll be introducing them again later during their various segments. And in this session, we'll be sharing about insights into investing into Singapore equities, particularly investing on SGX, and also some of our favorite investment ideas that you could consider for your portfolio. So let us now welcome our first presenter, Colin Low, Macro Research Manager at FSM1 Singapore, to share about his views on the outlook of Singapore and, more importantly, whether we still find Singapore equities attractive. So Colin, please.
Hi, good evening, everyone. I'm Colin. Like Sarah mentioned, today I'll be talking about the Singapore equities, and in particular, look at the outlook of Singapore equities in the second half of the year. And even more importantly, we'll discuss why we think Singapore's equity outlook will be, and is it attractive now at the current moment. So without further ado, let me jump right into the most important part of Singapore's economy. Of course, it is exports. So export itself is the integral driver of Singapore's economy. In the later part of slides, you'll see why. And from the chart right here, you can see quite clearly that Singapore's GDP growth tends to be driven significantly by the export growth. So the real GDP growth denoted by the dotted line shown from the chart here moves in strong tandem with the export growth as well as the 3-month moving average for the export. So if you smooth out the export, you can see that there is a very direct and clear correlation between both. And the reason is because you can see from the chart on the left-hand side, if we were to decompose the real GDP for Singapore, you'll find that, in fact, exports drives around 180% of Singapore's real GDP. So, in fact, it is the largest driver within the different categories. And even on that basis, even if you were to net out your import to find your net export accounts for about 31% of the total GDP contribution. So this is being captured by the chart on the right-hand side. And you can see that even net export as that basis is still one of the biggest driver in the Singapore's economy. And definitely, if you look ahead and we were to think that if we were to see export strength, we believe that if there is a strong export strength itself, it can definitely buffer some of the domestic weakness induced by the COVID recently. So let me show you why and our view on why export will be strong in the near term. So, for example, here you can see on the chart on the left-hand side, the Singapore's manufacturing PMI versus the services sector. So you can see 3 lines here. So the orange line denotes the manufacturing PMI and the black line denotes the order to inventory ratio. So that is a typical leading indicator for your manufacturing PMI. So you can see that both are trending higher in the recent months as opposed to the PMI for the whole economy. So that tells us one thing, and that tells us that manufacturing sector is remaining resilient as compared to the services sector. And services sector is the one that's dragging the economy down. And typically when we see rising or strong and above 50 manufacturing PMI, as well as your orders to inventory ratio, that tend to portend stronger export growth to come over the next quarter or so. So that is one near-term indicator for your export strength. And the other near-term indicator for export strength is coming from the low base effect. And if you look at the table on the right-hand side, which is capturing the export growth for 2020 itself, you'll find that the export growth for Singapore has been rather weak in 2020 for most of the year until November. So we do believe that low base effect should carry on this year, and largely to the third as well as the fourth quarter. So with both factors together, we likely see the strength in exports, especially in the near term, to continue in the second half of the year. So you may ask, what about the longer term picture? So overall, we think that the longer term picture is not bad as well. So if you look at the chart on the left hand side, which is the electronic exports, and plotted against the global semiconductor sales growth, you'll find that both are moving in close tandem as well. So that tells us that your global semiconductor sales growth is a strong driver for Singapore's electronic exports. And with our in-house outlook on semiconductors being rather strong, especially for the second half this year as well as next year, we do think that strong outlook because of the very favorable demand supply dynamics should definitely uplift your electronic exports, particularly in the second half of the year, moving into the next year as well. So That is one main longer term driver. And if you look at from a more top down level, especially looking at the demand coming from US as well as China, you'll find that the forecast for US and China import demand is expected to be strong and positive over the next 2 years. So no doubt the magnitude itself is declining, which we expect it to be so. It's still generally positive, and because of that, the combined US as well as the China import growth forecast actually suggests that Singapore's export growth should remain largely positive for this year as well as the next year. So all in all, these two factors are telling us that a longer term picture is not too bad either. So moving on from that, let me touch on to another key another key driver of Singapore's economy lately. So that is especially happening on the COVID front. So if you were to look at Singapore versus our neighbors itself, I do believe that we are ahead of our peers, especially on the COVID front, and that makes us relatively stronger through a macro lens. So if I were to direct your attention to the chart on the right-hand side, which shows the vaccination rates in Asia, you can see that Singapore is all the way on the left-hand side. So we have the highest percentage of population that is fully vaccinated and a strong number that is partially vaccinated as well. So all in all, it makes us one of the countries in the world that has a very high vaccination rate, and ongoing itself, the inoculation rate remains very strong, and we are looking at a possible herd immunity for the later part of the year, especially in the fourth quarter. So that is one thing that strongly separates us from our neighboring peers, and that itself is translating a lot into stronger economic momentum because the economy can ease off the restriction faster than compared to our peers, and as a result of that, the economy gets to move faster as well as stronger before everyone else, and that itself is helping us in terms of generating a lot of economic momentum moving on to the second part of this year. So I think some of you might think that the recent restriction, especially moving back into the phase two, might cause the economy some trouble. Yes, we do think that. We think that that itself might hold back some of the economic momentum, but we think that it is something that it is delaying the economic momentum, but not dismissing it entirely. So if you look at the chart on the left-hand side, which shows the mobility in Singapore across the different categories, like your retail and recreation, your parks, as well as your residential and transit station as well. So you can see from this chart right here, mobility did came down as we enter phase two again, but it was not as bad as previous restriction. So if you look at, for example, groceries, you look at residential, you look at transit station, as well as parks, all the different measurements of mobility did dip down, but they are not as bad as what we've seen somewhere in May. So which is the dotted box in the chart there. So with that said, the impact on moving back into restriction this time is definitely lesser than what we've seen before. And looking ahead, the government did say that they're expecting to review the kind of restriction in early August. So I think that is also putting a timeline on when we can possibly exceed that, and therefore I'm looking rather positive if we're to see when we can exit the kind of lockdown measures. So again, let's look at things more from a top-down perspective. And you can see from the table on the right, which shows the different GDP growth or real GDP growth for the regional economies. You'll find that Singapore's growth in 2021 is relatively stronger than many of the Asia as well as ASEAN peers. So in this year, consensus are expecting us to clock in about 6.5% year-on-year growth for GDP. And that is significantly higher than some of the peers out there. Even if you were to discount the fact that we have a low base effect, but if you were to compare us against some of our peers, such as your Philippines as well as your Malaysia, which have a lower base effect, but they are not seeing as strong as a rebound this year. And that itself is telling us that on a relative basis, growth in Singapore is still relatively better than some of the peers. And if you look at the kind of revision that we had this year, which is shown on the chart on the left-hand side, you can find that the GDP growth for this year, most of this year itself, is broadly revised higher in the year to date. And even you can see from the magnitude that GDP growth is revised higher by about 1%. So meaning that at the start of this year, analysts are expecting about 5.5% year-on-year growth for 2021's real GDP. But Right now, they're expecting 6.1, 6.5%, and the upwards revision occurred even though we entered the heightened phase 2 restrictions over the last few months. So then that itself is really a good sign that consensus are getting more positive on Singapore's economy. So if I have to put all the different points together that I've just mentioned, so for Singapore's macro outlook for the second half of the year and beyond, we're definitely looking at a very constructive outlook especially in the second half and to some extent early part of next year. And that appeal or the attractiveness is particularly stronger amongst when you compare us against our ASEAN peers. So if you look at from a tailwind as well as a headwind perspective, we do think that the strong export outlook itself is likely the main tailwind. But when you look at the downside of it, look at the headwinds of it, of Singapore's growth itself, there is no glaring headwind coming from Singapore economy, and because a lot of the macro risks itself are in fact limited by your fast inoculation rate. So I think that is actually a good thing when it comes to keeping the risk limited. So looking ahead, we definitely see a big contrast in the macro backdrop between Singapore as well as the Asian peers. So the Asian peers themselves are being hit hard by the recent outbreak. So this is a big point because we think that this itself can support your valuation expansion when we move forward, when two catalysts comes along. So firstly, it is when there is visible timeline for easing of restriction, and secondly, when herd immunity is perceived or is being signaled by the government. So those two are some things that we watch out for that could signal potential valuation expansion, and that is being based on the relatively stronger macro outlook. Yeah, so let me move away from the macro outlook into the market outlook. So starting right off with earnings. So as shown from the chart on the left-hand side, you'll find that Singapore is expected to generate strong EPS growth this year as well as the next 2 years. In fact, the next 2 years are expected to generate above average EPS growth. And we are looking at a 15% EPS growth for next year as well as 14% for the year after. So if you were to strip away that and look at things from a sector perspective, which is shown on the table on the right-hand side, you'll find that cyclicals are in fact the one that's driving EPS recovery. So a couple of examples are your financials, your industrials, your discretionary, where EPS growth is strong this year as well as the next 2 years. However, if you look at the non-cyclicals themselves, they are not doing too bad either. So you look at some of your IT as well as your utility, the EPS growth is considered relatively stronger, especially when compared to historical growth rates. So it shows that kind of recovery itself is largely still broad-based, but the cyclicals are the ones that's putting more of the work right now. So let me segue a bit to Singapore banks, which is in fact one of the most important segment of the Singapore equity market. So overall, our take is that the banks are positive prospect moving ahead, is anchoring the constructive outlook for the Singapore's financial sector, which is about 40% of the STI, and the banks themselves are about 36% of the STI. So based on our analysts covering the Singapore banks, here are a couple of takeaways. So for the first one, we do see that the potential US rate hike should come over the next 2 years, and that itself provides an upside to the Singapore's bank's net interest rate margin. And aside from that, Singapore bank has a fast-growing expansion in Asia, and that translates to a very attractive upside risk for your loan guidance. Essentially, that means that we are likely to see higher loan growth over the next couple of years. And aside from that, the steady fee income growth from your wealth management fees and as well as card fees, which are expanding over the past few years, have actually come in strong. And that itself can be further boosted when the economy reopens, especially in the third and fourth quarter. And alongside that, we are looking at easing loan loss provision as well as possible write-backs, especially for the second part of this year. So all that are actually quite positive for the banks, and they are translating into strong EPS growth rates for the next 2 years, and in fact, above average EPS growth rate. So if you were to look at the EPS growth over the next 2 years versus the kind of pre-COVID growth over the past 5 years, between 2014 and 2019, you'll find that the growth rates for the next 2 years, as well as this year, are still relatively stronger, and therefore fundamentals for Singapore banks are in fact stronger than before, and they are improving. So with that said, we definitely do see further upside in Singapore banks. No doubt that a big part of that upside has been realized over the past 6 months. But looking ahead, especially in the longer term, we do see a relatively constructive outlook for Singapore banks. So again, let us compare Singapore equity to the various regional equities. Firstly, you'll see that there is definitely a stronger near-term earnings prospect compared to our peers. And the reason is because of a positive macro as well as a vaccination rate. And that supports a very strong 49% EPS growth for this year, and to some extent over the next year as well. But if you look longer, we do think that the peers are actually catching it up. So something to note here is that on a longer term perspective, Singapore equities actually need the kind of high growth sector as well as the new economy stocks that is seen typically in, like, say, Taiwan, South Korea, or maybe even China. So those are the kind of stocks we need that can support your longer term earnings growth rate. But unfortunately, that is a bit lacking on Singapore equities. Therefore, on the longer term horizon itself, the fundamental backdrop is still the fundamental backdrop for our peers are in fact catching up to Singapore, and that I would say is the downside of Singapore equities. So now let us take a look at the valuation as a whole for SG equities. So you can see from the chart right here, Singapore equities are trading at a slight premium despite having derated significantly. So we are now looking at a minor premium of about 5% against your historical average. So while on an absolute level, we are trading at a slight premium, but on a relative basis, if you look at the relative valuation, I would say we are still considered relatively cheaper than peers, and that is a good thing when you consider the stronger macro backdrop that we are seeing right now. And it is a very positive aspect because I would expect the Singapore equities to price in the difference in the macro backdrop as well as the earnings backdrop into valuation level where we should be more aligned with our peers. But instead, we are saying that Singapore equities are in fact cheaper than the Asian peers. So that is shown on the chart on the right, especially on the one on the bottom right. You'll find that looking at the relative valuation, Singapore equities are in fact cheaper than Asian peers. And on the chart on top, we are still trading somewhere fair compared to our ASEAN peers. So because of the difference in the macro backdrop as well as earnings backdrop, I do expect us to be trading at a slight premium over that. But in fact, the fact that we are trading at a fair level or even at a discount, it tells us that we are still attractive on a relative basis. So the table on the left-hand side shows the forward PE ratio across the different ASEAN markets, both the current as well as the 10-year average. And you can see that Singapore right now, we are trading at a much smaller premium at about 5% compared to some of the markets out there like Thailand as well as Indonesia. And we are definitely at a smaller Z-score as well. So those markets are trading at a higher premium because of the collapse in the E as well. Yeah, so right now I would say that overall looking at relative valuation perspective, we are still fairly attractive. So let me touch on the dividend outlook for Singapore equities, which is a key equity driver for Singapore equities as a whole. So broadly looking ahead, I do think that Singapore equities are still a very good dividend play and a good dividend investing strategy as well. So it does have one of the highest payout ratio at 75%, which is currently, and even if you look at on a pre-COVID level, it's still 50%. So that is still considerably higher than what we are seeing, especially compared to the regional peers. And if you look at the payout ratio, it's definitely showing a historical trend of increasing. So that is another good point to note. And if you look at the chart on the right, it shows you that the Singapore equities right now is expected to generate about 4.3% dividend yield for end of this year as well as 4.5% end of next year. And both numbers are in fact very much above the historical average of about 3.6%. So overall, that makes us one of the highest dividend yielding markets within Asia. And if you look at the risk of dividend reduction, I would say right now it remains rather mild because of a firm earnings recovery coming from the banks as well as a rather constructive yield outlook for the REITs themselves. So those factors are still telling us that the risk of a possible dividend reduction is still rather mild moving ahead. So right now, let me put all things together. So there are a couple of key points that I mentioned. So firstly, we do see a faster inoculation rate in Singapore, and that actually translated into macro as well as earning strength for this year as well as early next year. And overall, if you look at the valuation level is still relatively attractive as compared to peers, especially when we consider the kind of rosier macro and earnings backdrop. And also when we look at the dividend, like I just mentioned, the outlook for dividend is still positive and it's still definitely one of the highest within the region. And on the risk perspective, when we look at the near-term risk itself, for Singapore, it's fairly limited. But if you look at our peers, in fact, they are facing a lot of pandemic fears, pandemic risks, regulatory risks, and those are the kind of risks that hold our regional peers back, but they are in fact less prevalent in Singapore. However, the longer term headwinds are still there. Like I mentioned earlier, Singapore equities definitely have a lack of a high growth sector as well as new economy stocks there. So that can hold back some of the longer term outlook. But broadly, if I were to put things all together, the outlook for Singapore equity remains broadly constructive, although it is more positive in the nearer term. And we do are expecting some upside of about 24% by end of 2023. So where Singapore equities truly shines when compared to the regional peers, especially over the nearer term picture, and I'm talking about for the next 12 months. So the second half of this year as well as early part of next year. So that is where Singapore equity truly shines. So our stance and our strategy for Singapore equities is that we feel that Singapore equities on aggregate are a good pick for investors seeking exposure to Asia as well as ASEAN right now. So it does definitely offer a very good risk reward. And even if the reward side doesn't work out and market trades sideways, I think investors are still good collecting the dividend from Singapore equities. And aside from that, the valuation right now implies a fair point of entry for investors. And for investors that are looking to ride the kind of reopening wave, we think that Singapore equities have priced in part of this positivity, especially if we look at the market performance in first half of the year. And we see that the Singapore equities has in fact moved up a lot, especially in February, so pricing in some of that possible reopening. However, that said, we still think there's some more room to go for investors who want to ride out this wave. So there are a couple of catalysts that we are watching along the way, as I mentioned earlier in my slide. So the first one is definitely an exit from phase 2, as well as a visible timeline for herd immunity. And the second catalyst we are looking at is for Asia's reopening timeline possibly becoming more definite, and that can also drive further upside for Singapore equities. So with that said, I think that is the strategy we have for at least for a short-term perspective. Whereas for a longer-term perspective, for longer-term investors, there is still a need to keep an eye on valuation level, given that right now we are still at Singapore equities are still fairly valued. But for investors who are intending to hold a longer term, there's still a need to keep an eye on valuation level. And secondly, also when the above average earnings growth, like I mentioned earlier, starts to moderate. So that is when I think investors have to really take note and really look at the positioning again. But that said, I think our stance is still that Singapore equities are still a good pick for investors seeking exposure to Asia as well as ASEAN equities right now. So that said, I've come to the end of my presentation, and I shall pass on my time to the next speaker.
All right, thank you, Colin. Okay, next up, we have Darren Liu from our investment advisory team. So some of us may be new to investing on SGX, or perhaps you're unsure of what to look out for. So in this segment, Darren will be highlighting the benefits of investing in SGX stocks and ETFs, as well as also sharing some tips to look out for and how to trade on our platform, FSM1.com. So let us welcome Darren.
Hi, thanks, Sarah. So I'm Darren from the investment advisory team. So today I'll share with you about the SGX Trading 101. So I'll touch on the reasons to trade in the SGX, some considerations, and also the various tools and functions we have on FSM1 that can help you with your stocks and ETF investments. This is an overview of the content which I will be covering in the next few slides. So at any point in time, if you have any questions, please type them in the Q&A box, and we will try to address them in the Q&A session later. So firstly, why do we want to trade SGX stocks and ETFs? So one of the reasons can be the familiarity with the listed companies. So you may be already using some of their products or services, which makes it easier to understand their core businesses and also the recent performance. So some of these companies include your local banks like your DBS, your OCBC, and UOB, where almost all Singaporeans use. So next we have Singtel for your phone and also internet services, and ComfortDelGro for your taxis, buses, and MRT. So besides that, information such as the annual reports are readily available. So the company announcements can also be found on the SGX portal easily. Secondly, it is for dividends. As Colin mentioned earlier, SG stocks and REITs, they pay one of the highest dividends. And SGX have an established real estate investment trust, a REIT market, which is anchored by a large reputable companies such as your CapitaLand, your Mapletree, and Ascendas. So the two largest REIT ETFs across Asia Pacific ex-Japan are listed on the SGX too. They are namely the Nikko AM Straits Trading Asia ex-Japan REIT ETF, and also the Lion Philippe S-REIT ETF. So lastly, for Singapore dollar-based investors, it is also easier to manage the currency risk because there's no need for you to change your SGD to other currency for investment, and also to worry about any like currency fluctuations. Next, I'll touch on the things to note when you're trading SGX stocks and ETFs. So first is the liquidity issue. So on the liquidity front, it is actually tough for Singapore to beat other exchanges like Hong Kong or US, where they deal with much higher volumes. And some of the lesser known stocks in SGX, they may see low volume due to little interest in the counter, so you may not be able to buy or sell them easily. Secondly, it is the limited growth opportunities. As Colin mentioned earlier, the Singapore stock market is shrinking over the years as there are more delistings and listings here. And also it's mostly made up of like mature companies and not really of high growth companies. So in addition, the high growth companies tend to list elsewhere, such as Hong Kong or US exchanges where there's a bigger market. Lastly, is a home buyers concentration risk. So home buyers is a phenomenon where investors tilt the bulk of their portfolio to investments in their home country. So there is a risk of not diversifying globally, as when the recession comes, your portfolio could be badly hit if they have only like Singapore stocks or ETFs. So you may wonder, when you buy your SGX listed stocks and ETFs, where are they being kept? So unique to the SGX, the shares can be held either in a central depository, the CDP, directly, or held in the central or the CDP depository agent, which is a CDP-DA sub-account. So basically, a CDP account is operated by the SGX. It provides integrated clearing, settlement, and depository facilities for customers in the Singapore securities market. So if you are trading on FSM1, you do not really need a CDP account to trade SGX stocks, as we maintain a sub-account with a CDP on behalf of each client. So some of the roles of the CDP are as follows. So basically, they inform the DAs of the benefits and the actions required. So on behalf of the SGX listed companies, the CDP informs the DAs of the benefits accruing to securities and of corporate actions and activities which require the action. Secondly, they collect and distribute entitlements. So basically, CDP collects entitlements, including the cash or scrip dividend, the interest and bonus shares on behalf of the account holders, and distribute the entitlements in accordance to the depositors' shareholdings on the record date, as reflected in the CDP system. So thirdly, they act on behalf of the DAs. So basically for corporate events such as the subscription of rights issues, takeover offers, and other voluntary corporate actions, the CDP will seek the instructions from the DAs and take the actions on their behalf. This is an overview of the trading SGX stocks and ETF with FSM1. So basically, your trading account with FSM1 is open with iFast Financial Private Limited, who is a SGX ST trading member, a CDP clearing member, as well as a depository agent. So when you buy securities with FSM1, they are custodized with iFast, and we will also maintain a sub-account with CDP on behalf of each client. So on the other hand, if you bought your SGX stocks or ETFs previously, and it is stored in your CDP account, you can actually link it to your FSM1 account and sell them via the FSM1 platform to enjoy our low fees. So these sell trades will still be reflected in your CDP securities account statements, but you'll receive the contract notes from FSM1. At FSM1, you can trade in a SGX, and also we are proud to say that we are one of the lowest trading fee for trading SGX. And regardless of your trade size, all clients enjoy a flat trading fee of 880 Singapore dollars. So for selected SGX listed stocks and ETFs, investors can also use their CPF OA and SRS monies to invest too. So these are some of the investment tools for stocks and ETFs. So our research team has curated a list of stocks within the thematic portfolios, which seeks to identify and capitalize on the long-term mega trends, which will drive tomorrow's markets. So some of these trends include the aging population, the China urbanization, the millennials, the digital consumption, and the smart cities. So for income and value investors, there is also a portfolio for this team. So next, one of the common questions that we get from investors is not knowing which ETF to pick, as there are thousands of them. So on our website, you'll be able to find the ETF Focus List, which is serve as a starting point for your investment decisions. We have classified these ETFs into 6 broad categories, such as the core equity, the fixed income, the country and sector-specific funds, as well as tactical play ideas. This list is refreshed yearly, and the funds are selected based on qualitative and quantitative factors, as a choice of underlying index, the AUM, the expense ratio, the tracking error, the liquidity, and the replication method. So to bring that further, we also allow investors to invest via a regular savings plan strategy. So as mentioned earlier, we have a thematic portfolio which seeks to identify and capitalize on long-term mega trends that will transform the world tomorrow. So these portfolios are built on innovative ideas that will not only allow investors to participate in some of the world's most promising investments, but also provide diversification at the same time. So speaking of the watch list, you can also see the stocks that are most watched by all FSM investors, and you can also sort by the different exchanges. Next is about the ETF Focus List. So with over about 2,000 ETFs available on FSM, it can get very, very confusing on how to start your search on what is good. So this is why we have created this ETF Focus List, which selects the top ETFs from across various categories for you. So for the SGX listed ETFs, there are some of them in the list which you can invest. So they are shown here in the slides. You can also use your CPF OA and SRS to invest in some of the approved ETFs, such as the STI ETF, the China Government Bond Index ETF, and also the Nikko AM Straits Trading Asia ex-Japan REIT ETF. So also, we are currently running a promotion where you can enjoy 0% processing fees for ETF RSPs till December 2021. So however, do note that the only trades in cash are available for this, eligible for this promotion. So your CPF and SRS RSP transactions are not eligible. So since the start of the year, we have witnessed unprecedented economic events and market volatility. So rather than trying to catch the bottom and time the markets, we have always recommend our investors to adopt a dollar cost averaging strategy. So this is the time where you start a regular savings plan, RSP, and you invest a fixed sum religiously, whether it's a rain or shine, into the markets. So on our platform, we do have enabled a selected list of ETFs, and the minimum investment starts with $50 a month, with a very affordable subscription fee of $1. But as mentioned earlier, the processing fee is waived for cash transactions till December 2021. So other than those features I mentioned, we also be able to participate in stocks IPOs and also ETF IOPs, and also to be alerted of any corporate actions on your securities. So you may also opt for scrip dividends and participate in rights issue and to register for EGM or AGM via your investment account online. So even our CDP linkage form can be submitted online, and this will allow you to sell your CDP stocks or ETFs via our platform at the same flat rate of $880. You can subscribe online for the pre-IPO placement tranche as well as the public tranche of the IPOs of SGX stocks and ETFs, where available on the FSM platform. And also, if traveling out to the ATM just to subscribe to an SGX IPO sounds like too much of a hassle to you, you can also now subscribe to the selected new SGX IPOs online via FSM1 or from the comfort and safety of your own home. For managing corporate actions, so you can view and submit your corporate actions notices for stocks online anytime, anywhere by logging on to your FSM account in the live trading platform under corporate actions. So the shareholder meetings registration is made easy in 3 simple steps. So first, the corporate actions related to your shareholding will be sent to you via email. Next, you will log into your FSM1 account and register your interest to attend. Then lastly, a notification will be sent to you regarding the outcome of your request to attend the shareholders meeting. Next, for clients who are entitled for election instructions, we'll inform you via email or mail and all you have to do is to log into your account online to make your decision, after which a separate statement will be sent to you via email after the completion of the event. So with your FSM1 account, you'll be able to have the convenience of performing your election instruction anytime, anywhere. So to link your CDP to your FSM1 account to sell your CDP stocks and ETFs, you can simply log on and apply to link your CDP securities account at Account Settings, Sell from CDP, as shown here. So you are required to fill up your CDP securities account number for this online submission. So once submitted, the linkage process will take about approximately 2 to 3 days to complete, 2 to 3 business days to complete. So you'll be notified via email on the outcome of the linkage. So do note that you can only link your CDP personal account to your FSM1 personal account and CDP corporate account to your FSM1 corporate account. Other account types like joint or beneficiary are not accepted. So I hope everyone have found this session useful and learned something today. So should you require any assistance, please feel free to reach us via any of the method and we'll get back to you. Yep, so now I'll pass the time back to Sarah.
Thanks, Darren. So next we have Yo Hui Shi. She's an equity analyst from our stocks and ETFs research team. So she will be recommending some investing ideas and how you can position your portfolio for a sustainable stream of passive income. So Hui Shi, please.
Hi, good evening, everyone. Thank you for joining today's webinar. I'm Hui Shi from the Stocks and ETFs research team. 2021 so far has been a pretty slow year for the Singapore REITs. And today, with the near-term challenges such as the spread of the Delta variant, as well as expectations of inflation, I'm here today to share on our outlook on Singapore REITs for the second half of 2021 and beyond. So not sure if you guys remember, but in 2020, the best performing REIT in the entire sector was actually Keppel DC REIT, while the worst performers came from different subsegments such as hospitality, retail, as well as office. However, so far this year, it is quite obvious that the tables have turned. Last year's losers, which are the office and the retail REITs, they have delivered the strongest returns thanks to the market rotation into value on the back of an economic recovery. And meanwhile, last year's biggest winner, which is Keppel DC REIT, has underperformed the broader sector, delivering a loss of -1% during the -9% during the first half of this year. And meanwhile, it's also worth noting that the hospitality REITs have continued to underperform. As international travel still remains at a standstill, this has also eroded the investors' sentiments. So turning our attention back to the this year's biggest winner, which is the office REITs. With their very strong performance this year, I think the main question is, should investors stick with this winner? And well, the short answer is no, as the leasing environment for offices still remains very challenging. More companies have been adopting a hybrid work model, and as such, tenants are also reassessing their office needs. And some companies find that they do not need as much office spaces as they do before. So for instance, DBS is planning to cut office space by 20% over the next few years as they adopt a hybrid work model and redesign their workspace to encourage more collaboration. And historically, the financial sector has been the main driver of office demand in Singapore. But today, these same firms have been reducing their spaces in the CBD as they shift towards a hybrid work model. And the DBS example is just one of many. There are other companies, especially those in the financial sector, such as Standard Chartered and OCBC, who are also planning to cut their spaces over the next few years. And in fact, as estimated by Cushman and Wakefield, the financial sector is estimated to release at least 500,000 square feet of office spaces by 2022. And that is equivalent to about 20 floors of office space at an office building in the CBD. But on a more positive note, while the financial firms have been cutting back on their spaces, at the same time, you will find that there are more tech companies who have leased or are currently looking to lease spaces in the CBD. However, demand from the tech sector, although it is strong, it is unlikely to be strong enough to be able to fully absorb the spaces that will be left behind by others, as well as the supply in the pipeline right now. And in fact, office vacancy rates in the Singapore CBD has been increasing. It has doubled from around 2% in the first quarter of 2020 to now about 4.5% as of the second quarter of this year. And with the weak leasing environment, we believe that vacancy rates could continue to increase, and this will also in turn put a downward pressure on the rental rates. And at this point in time, there is an office REIT that I'm quite concerned about, which is Keppel REIT. The share price of Keppel REIT has recovered quite a fair bit until this morning, while its fundamentals still remain quite weak. Financial firms who are at the risk of downsizing make up close to 30% of Keppel REIT's net leasable area. And that is not only its largest tenant sector, but it is also one of the highest amongst the Singapore office REITs. And Keppel REIT's anchor tenants, they include DBS and Standard Chartered, both of which have already announced that they are planning to cut their office spaces over the next few years. And as the rental rates and the occupancy rates remain under pressure, we believe that the portfolio valuation of Keppel REIT could continue to decrease. And at a forward distribution yield of around 5%, we believe that investors are not compensated enough for taking on such risks. And this is because there are other REITs such as Mapletree Industrial Trust and Ascendus REIT, which are offering similar levels of yield, but with much more resiliency as well as stronger fundamentals. And finally, based on a dividend discount model, we have a target price of around $1 for Keppel REIT. And this will imply a downside potential of close to 20% based on last Friday's closing price. And currently, Keppel REIT is trading at a PB ratio of 0.9 times, which is above its historical average. And if any portfolio revaluation losses were to be accounted for, then its book value is likely to decrease, and this will also in turn push up its PB ratio. And on the other hand, you can also see that the forward distribution yield of Keppel REIT is below the historical average. Hence, this suggests that the valuations are on the expensive end. And so in any case, if you are currently holding on to Keppel REIT right now, we believe that you should consider taking some profits off the table as valuations are unattractive while the fundamentals will remain weak for the foreseeable future. So next, moving on after office REITs, the second best performing sub-segment so far this year was the retail REITs. And the strong performance of the retail REITs was mainly supported by a very strong DPU growth that was due to last year's low base. And currently looking at the market rental rates, you can see that the suburban malls have been far more resilient, as their rental rates have remained fairly stable over the past year. And this is likely due to its close proximity to the residential areas, and hence the suburban malls are also a likely beneficiary of the shift towards a hybrid work model. And meanwhile, for the downtown malls, which are more reliant on tourists as well as office workers, their rental rates have been under pressure ever since the start of the pandemic. And looking ahead, we believe that the suburban malls will continue to be much more resilient as they tend to have a higher exposure to defensive offerings such as F&B and experiential trades, which are also more resistant against the competition from e-commerce. However, what I'm more concerned about right now for the retail REITs is the potential near-term impact from the pandemic. The COVID situation is still very fluid, and during the last few months, Singapore has moved back and forth between phase 3 and phase 2 heightened alert. And while we may start to see a loosening of restrictions this month, generally the retail REITs, they still face several downside risks. And this includes the tightening of restrictions, the temporary closure of malls, as well as rental waivers that they may have to give out to their tenants. So all this, they will lower the income of a retail REIT, which will in turn affect the distributions that they are able to pay out to their investors. And currently looking at the valuations of the retail REITs, their PB ratio has been recovering steadily and it still remains below the pre-COVID levels. However, considering the recent recovery as well as the potential near-term uncertainties and downside risks, I don't think that the valuations of the retail REITs are a good enough bargain. And in fact, their share price could possibly reprice lower in order to reflect a slower than expected recovery. And so at the current juncture, we believe that investors can definitely look for better investment opportunities in other subsegments of the REIT sector. Hospitality REITs could be something to consider, but investors will have to be selective. The recovery amongst the hospitality REITs is pretty uneven. There are some that are recovering at a much faster pace, while there are also some that are recovering at a much slower pace as compared to others. And as all of us are aware, international travel still faces a very long road to recovery. But on a more positive note, vaccinations have continued to roll out across the world. And currently, developed markets such as the US, the EU, and Singapore, more than 50% of the population have received at least one dose of the COVID-19 vaccine. And with such rising vaccination rates, domestic travel in the overseas markets such as the US has also picked up. And generally, domestic travel, it is recovering at a much faster pace as compared to international travel. So for investors who wish to capture the recovery in domestic travel, they can consider a REIT called AAUS Hospitality Trust. We believe that this is one of the hospitality REITs that will see a faster recovery to their pre-COVID levels. So for AAUS Hospitality Trust, it holds a portfolio of Hyatt and Marriott branded select service hotels in the US, and they predominantly serve the US domestic market. So to give you some background on hotels in the US, unlike the hotels in Singapore, hotels in the US, they are not classified based on the number of stars they have, be it a 5-star or 3-star hotel. So for hotels in the US, they are classified based on the level of service that they provide to their guests. And generally speaking, there are 3 different types of hotels, which are full service, select service, as well as limited service. So the ones being held by ARA, they are called select service hotels. And as the name suggests, the hotels provide selected services and amenities, such as reduced F&B offerings, as well as smaller meeting spaces. So for instance, the hotels have some restaurants, but they do not provide any room service at all. And as such, around 90% to 95% of the hotel's revenue will come from the rooms alone. And this allows them to be much more resilient, as they tend to have a lower break-even occupancy rate as compared to a full-service hotel in the US or so-called 5-star hotel in Singapore. So supported by very high vaccination rates as well as the recovery in consumer confidence, the US hotel market has seen a very strong pickup in domestic demand. And this has also resulted in record high revenue per available room, also known as RevPAR, as well as occupancy rates ever since the start of the pandemic. And in fact, as of June this year, the RevPAR and the occupancy rates are already nearing the pre-COVID levels. And this is a huge difference as compared to the Singapore hotel market, where the RevPAR and occupancy rates are still pretty much under pressure. So with the strong recovery, the management of ARA US Hospitality Trust expects property valuations to recover as well, hence helping to reduce its gearing ratio. And based on the dividend discount model, we have a target price of 63 cents USD for this REIT. And this represents an upside potential of about 17% based on last Friday's closing price. And one point to take note is that the REIT had recorded a loss last year, so it did not pay out any dividends. But with the recovery in revenue, we believe that this REIT is able to record a turnaround in their distributable income this year. So this will pave way for a dividend resumption, which we believe will be a major share price catalyst and help drive a re-rating. REITs, they are obligated to pay out at least 90% of their income. So this will roughly translate to a yield of around 4% to 9% from 2021 to 2023. And nevertheless, while the US hotel market has been heading in the right direction, a key downside risk for investors to take note of will be the spread of the Delta variant across the US, which could affect international travel and also to a smaller extent, domestic travel as well. And last but not least, now let's move on to the other subsegments of REITs that investors are often very interested about, which are the likes of the data center as well as the industrial REITs. And in fact, the most popular REIT among investors last year was actually Keppel DC REIT. And we understand why this is so, because Keppel DC is the only pure play data center REIT in Singapore, and it also was the top performer last year. However, you can see that the tables have really turned so far this year for Keppel DC REIT, as it has become one of the worst performers in the entire sector. So does that mean that it is now a good time to buy into Keppel DC? And the short answer is, again, no. Even with the reversal in the share price performance this year, we believe that the valuations of Keppel DC is still on the expensive end. It is currently trading at a PB ratio of more than 2 times, which is at a considerable premium to the industrial REITs. And we believe that this premium should narrow as industrial REITs such as Keppel DC has been facing increasing competition from the industrial REITs such as Mapletree Industrial Trust as well as Ascendas REIT, both of which have been increasing their data center exposure. So for instance, over the past year, Ascendas has acquired more than 10 data centers in Europe, while Mapletree Industrial Trust has proposed to acquire close to 30 data centers from the US. And moreover, Digital Realty, which is one of the largest data center REITs in the US, is exploring a potential listing of a data center REIT in Singapore. And so if this happens, then Keppel DC will no longer be the only pure play data center REIT in Singapore. So against this backdrop, with increasing competition as well as lofty valuations for Keppel DC, we believe that investors can consider certain industrial REITs for not only higher yields, but also for more value. Over the past year, there has been a lot of hype on data centers. And yes, indeed, data centers, they are attractive. The shift towards cloud services as well as the future adoption of 5G will lead to higher data traffic, and this will also in turn lead to a greater demand for data centers moving forward. However, investors, they often overlook the logistics properties, which are another fast-growing real estate asset class. So logistics properties, they stand to benefit from the acceleration of e-commerce. So this will drive demand for warehouse spaces and hence supporting the long-term growth in rental rates. And at this point in time, we like Ascendas REIT. It holds a diversified portfolio of assets, which includes logistics properties as well as data centers. And most of the assets under the portfolio are expected to be resilient as they are positioned to ride on the key trends of the post-COVID economy. And earlier this year, AREIT has boosted its data center exposure through the acquisition of 11 European data centers. Investors could possibly have even more to look forward to, as AREIT has a debt headroom of close to $4 billion for it to fund future acquisitions. And such future acquisitions could be even more data centers or even other assets that can allow it to future-proof its portfolio. And based on the estimated DPU, AREIT is currently offering investors with a yield of over 5%, and that is considered as one of the highest amongst the blue chip industrial REITs. And as you can see from this chart above, the share price of AREIT broadly tracks its DPU. And so with its DPU estimated to increase, we believe that there will also be upside potential in terms of the share price as well. So this will actually sum up our outlook on the Singapore REIT sector. And currently looking at the sector as a whole, supported by the recovery of the retail as well as the office REITs, the valuations of the S-REIT sector as represented by the FTSE ST REIT index are also reaching the pre-COVID levels. And this is despite an uneven recovery across the board, as well as an uncertain outlook for certain subsegments such as the office and retail. And moreover, a near-term headwind for the REITs will be rising interest rates due to inflation. REITs, they are highly leveraged. In order for them to generate very strong growth, they often borrow money to acquire assets. And so higher interest rates could mean higher interest payments, which in turn lower the income of REITs. And also higher interest rates will increase the cost of borrowing, and this will reduce the ease of asset acquisitions and hence taper inorganic growth. However, from another perspective, inflation is also a sign of an improving economy. So this could possibly mean improving occupancy rates as well as rental rates for certain subsegments of REITs, such as the hospitality REITs. And against this backdrop, we believe that investors should choose REITs with stronger fundamentals, as stronger fundamentals could help to negate any negative impact from rising rates. And fundamentals in the case of REITs will be referring to the quality of the underlying assets, their gearing ratio, as well as their occupancy rates, so on and so forth. So basically, in order to achieve sustainable passive income through REITs in this current market, investors should be able to focus on the long-term outlook while keeping in mind the possible near-term downside risks. And we generally prefer the industrial as well as the data center REITs due to their stronger fundamentals. And at the current juncture, we believe that the industrial REITs will offer more attractive valuations. And our pick for this will be Ascendas REIT. And meanwhile, if you wish to play the recovery team, our recommended REIT is AAUS Hospitality Trust. With the strong recovery in domestic travel in the US, we see improving fundamentals for AAUS Hospitality Trust. However, do take note that if you wish to invest in such recovery plays, the allocation should be incremental rather than going all in, as the spread of the Delta variant still remains as a key downside risk for such investments. And with that, I actually come to the end of my sharing for today. So now I hand the time over back to my colleague.
Okay, thank you, Hui Shi. So now we are at our last segment. So with us is Chloe Halim, also an equity analyst from our stocks and ETF research team. So she'll be sharing 3 small cap investment ideas that are often unheard of and we consider as hidden gems on SGX. So Chloe, please.
Good evening, everyone. So I'm Chloe. I'm an equity analyst from the stocks and ETF research team at IFAS. So thanks again for joining us for this webinar. And today I'll be sharing 3 small cap investment ideas that one should know about when looking to invest in the SGX market. So what exactly are small cap stocks? In Singapore, small cap stocks are commonly defined as companies with a market cap below 1 billion. So small cap stocks can be considered good investments due to their attractive valuations. And relative to bigger companies, some small cap companies typically show much higher growth potential. However, with little or no coverage by analysts, they are often forgotten or neglected by big financial institutions. And thus, opportunities actually exist within this space, and prices can well shoot up once they start to garner more attention. However, it's actually up to investors themselves to uncover these opportunities. So with this in mind, I have 3 small cap investment ideas for you all to consider today. So first and foremost, we have Trendlines Group. So for those who are unfamiliar with Trendlines Group, let me give a bit of background to this company. So Trendlines Group is an Israeli-based incubator with a presence in Singapore. Trendlines Group actually invests in early stage, high growth, innovation-based startup companies. They focus on medtech as well as agtech companies, as these are the 2 areas in which the management has expertise in. So for many individual investors, there are actually a limited few publicly listed incubators in the world, and other avenues to invest in incubators are often out of reach, and hence Trendlines actually fills this gap. So as seen from just a sample of their portfolio companies, they belong to the medtech and agtech sector, and these 2 sectors are beneficiaries of trends such as an aging population as well as increasing demand for food and nutritional security. Trendlines Group has also been recently making headlines. So some examples include the group announcing that they have actually received a non-binding letter of intent for the acquisition of one of the portfolio companies in April this year. So later in May, Trendlines Agri-Food also announced that they'll be partnering with Mitsubishi to actually identify emerging agtech startups. And so in my subsequent slides, I'll actually be covering some of these recent developments. So given that Trendlines has received a non-binding letter of intent for the acquisition of one of its portfolio companies, it also means that an exit opportunity has arisen. This exit opportunity could potentially be worth at least 19 million in cash. And as seen from this table here, Trendlines has experienced plenty of success when it comes to exits over the years. So to date, Trendlines has actually completed 9 exits with an average return of about 8.7 times the initial capital invested. Also, do note that the average value of exits was about 3.5 times greater than the book value before the exit, and thus this new potential exit opportunity should be something that investors can look forward to. For Trendlines, they also have recently established a new partnership with Mitsubishi's food division. So this partnership is synergistic as Mitsubishi is able to leverage on Trendline's expertise in technology to actually scout for AgTech opportunities. And at the same time, Trendlines is also able to gain valuable insights from a market industry leader. Not to mention, Trendlines is also able to tap on the capital provided by Mitsubishi to actually co-invest in the most promising AgTech startups. And this partnership with Mitsubishi is actually not surprising considering that over the years, Trendlines has accumulated a large network of partners with other industry leaders in the MedTech and AgTech field, such as Bebron, Bayer AG, and Nutrico. So initially, Trendlines also announced in April that they were planning to dual list on the Israel Stock Exchange. And this was actually an attempt to address their valuation gap and raise more capital, as historically, Trendlines actually trades at a 45% discount to its book value. And the management has actually expressed frustrations with this wide valuation gap and feel that a dual listing could perhaps attract more investors and increase the stock's liquidity as well as share price. However, as of 22nd July, Trendlines announced that they have shelved their plans to actually dual list in Tel Aviv Stock Exchange. And they made the decision following the fact that they feel that the general economic and capital market conditions were not favorable to the company. But despite this setback, the fundamentals of Trendlines Group actually remains intact. And moreover, as you can see in this table here, Trendlines is hugely undervalued compared to its peers who actually have a portfolio of investee companies. So our target price for Trendline Group is that of 14 cents, and this is actually based on a fair PB ratio of 0.85 times. So this would translate into an upside potential of 37%. And moving forward, our prospects for Trendlines Group actually remains bright as we expect to see a trend of much larger exits, as the overall portfolio is actually made up of companies that are more mature as they've been incubating for a while and thus are closer to exits. So for my second small cap investment idea, I actually have ClearBridge Health. So this company is a healthcare company that focuses on delivering precision medicine tools in Asia with a focus in Southeast Asia. So we feel that ClearBridge Health should continue to grow as the group is well positioned to ride on the increasing demand for medical services within the Southeast Asian region. So as seen here, a large part of ClearBridge operations are in Southeast Asia and will continue to be so as the group goes on to expand in this region. So why exactly is ClearBridge focusing on Southeast Asia? It's precisely due to the fact that the region is actually severely lacking in healthcare resources as well as infrastructure. So for instance, as you can see here, there's a chronic lack of doctors within the Southeast Asian region. So when we look at the 5 most populous countries in Southeast Asia, which is of the Philippines, Myanmar, Thailand, Vietnam, and Indonesia, they actually have an average of about 0.8 doctors per 1,000 people. And this is much lower than the global average of 1.5 and way behind Singapore, which has 2.3 doctors per 1,000 people. And on top of that, we see there's a lack of hospital beds to actually serve the population. Again, for these 5 most popular Southeast Asian countries, the number of hospital beds per 1,000 people falls below the global average of 3. But despite this, the 3 powerhouses of healthcare growth are actually found in Southeast Asia's most populous countries, which is that of Indonesia, Philippines, as well as Vietnam. So look at this environmental scan here. It actually points out that they suffer from a supply side issue arising from an underdeveloped healthcare infrastructure, but yet these countries are actually expected to bring an enormous amount of healthcare demand due to their high GDP growth as well as their growing population. As such, ClearBridge Health has been actually aggressive in expansion efforts in the Philippines as well as Indonesia. So to take advantage of the opportunities in Indonesia, ClearBridge Health is actually making use of a public-private partnership, also known as a PPP model, to reach the masses and scale its operations. So they will come in as an external vendor to manage the public hospitals, and they will split the revenue with the local governments on a 70 to 30% basis, where ClearBridge actually gets 70% of the overall revenue. And in total, they actually manage about 43 joint hospital contracts, and they serve about 4 million Indonesian patients over the year. And as a result of these growing operations in Southeast Asia, the group has actually achieved an exponential growth in terms of their revenue. And they've gone on to record revenue of about 36 million in FY20. And over the past 3 years, the company has actually been growing at an impressive CAGR of 143%. And for a company that was only listed in December 2017, ClearBridge Health has also gone from loss-making to that of profitable in FY20. So last but not least, I move on to the valuations of ClearBridge Health. So despite its growth potential, ClearBridge Health is actually undervalued compared to some of its peers. And our target price for ClearBridge Health is 19 cents, and this is based on a fair PE multiple of 7.5 times. And this translates to an upside potential of 37%. And moving forward, we feel that the company actually remains well positioned to benefit from the tremendous growth opportunities that exist within these highly popular Southeast Asian countries, as mentioned earlier. So for my last company, we'll actually be looking at Q&M Dental Group. So I think some of you will be familiar with this dental group, as they are actually the leading private dental healthcare group in Asia, and they have the largest network of private dental outlets in Singapore. And one thing to note is that last year, Q&M ventured into the COVID-19 PCR testing business, and this has been a growth engine for the group moving forward. So when we look at Q&M, we see that its core dental business is highly resilient even in the face of the pandemic. So the group actually managed to achieve a 6% revenue growth despite many disruptions faced in the first half of 2020 last year, such as Singapore's circuit breaking period during the months of April to June. One thing to note in general is that dental services tend to be more resilient compared to general medical services due to the fact that there's often no self-medicating alternatives available. And further contributing to Q&M's revenue growth is that of border closures. So Singapore patients are now unable to actually seek out cheaper dental services in neighboring countries such as Malaysia, Thailand, and even Vietnam. And this actually drives up the domestic demand for dental healthcare services. And we see Q&M's business as one that is constantly growing due to the company's aggressive expansion strategy. So if you look at this chart here, you see that the number of Q&M dental clinics have actually grown tremendously over the years. And despite Q&M being the largest private dental provider, there's still ample room for the group to continue expanding. So as currently, Q&M has about a 10% market share in Singapore, which leaves room for the group to further grow without cannibalizing its own revenue. So this further room for growth is also supported by the fact that currently Singapore's dental healthcare market is far from saturated. So Singapore actually has a shortage of dentists with only 4.1 dentists per 10,000 people as seen here. And moving forward, Q&M actually aims to open about 30 dental clinics a year, which about 20 in Singapore and 10 in Malaysia. And this will occur from 2021 onwards for the next 10 years, as this is the management's target. So last but not least, I want to mention that Q&M has actually expanded into the medical laboratories and research industries with a 51% owned Acumen Diagnostics. So some recent developments with regards to Acumen Diagnostic is that in May 2021, Acumen was actually selected as one of the 6 successful awardees in the open tender exercise conducted by HPB. So this tender means that Acumen can actually provide PCR testing services for individuals who are living in dormitories as well as those going for testing at regional screening centers. And given the fact that there's a rising number of COVID-19 cases and that COVID-19 is increasingly becoming more and more common due to the fact that it's an endemic and it's here to stay, we expect to see sustained demand for such testing services. So on average, the net profit margin for PCR testing services is actually that of 25%. And we see this segment as a new growth engine to actually look out for. So moving on to the valuations, again, a similar story where Q&M is actually undervalued relative to some of its healthcare peers. And we actually have a target price of $1 for Q&M Dental Group, and hence investors can actually expect an upside potential of about 24%. And we also see that Q&M has been recently giving out an attractive dividend yield, and we actually see a prospective dividend yield of close to 4% moving forward. So all in all, to sum up, here are our 3 SGX small cap investment ideas. And with this, I end my presentation. So thank you very much for listening.
All right, we have come to the end of the webinar. Thank you again to all our speakers, Colin, Darren, Huishi, as well as Chloe. And also thank you to our attendees for listening so patiently to all our various presentations. And we hope that through this session, you have managed to get some investment ideas that will be helpful for your portfolio. With that, we've come to the end of today's session. So thank you, everyone.